Let's dive right into today's explainer, where we'll be exploring the fundamental building blocks of the Indian securities market. If you've ever wondered what's actually happening behind the scenes when you invest your money, you're in the right place. We're going to unpack the basic securities of the market that fuel our entire economy. To make this vast financial universe a bit more manageable, here's our roadmap for today. 1. The purpose of securities. 2. Market structure and regulators. 3. Decoding equity securities. 4. Debt and money markets. And finally, 5. Mutual funds and ETFs. Let's get to it.
Kicking things off with Section 1, the purpose of securities.
So, what exactly is a security? I mean, it's a word we hear literally every day, right? But what's its actual purpose in our economy? It's super easy to think of stocks and bonds as just blinking red and green numbers on a screen, but they actually serve a very real, tangible function. Think of the securities market as the essential plumbing of the whole economy. It's what efficiently channels your savings into productive business investments. Imagine you've got some extra cash sitting idle, and a company out there needs capital to build a massive new factory or launch the next big tech product. Well, securities act as the bridge connecting the two of you. Without this flow of capital, economic growth would literally just stall out.
And this dynamic right here, this perfectly captures the core reality of every single investment you will ever make. It's the ultimate balancing act, weighing the expected benefit against the chance of things going south. This is the fundamental law of finance, folks. If you want a higher return, you absolutely must accept a higher risk, the risk that those returns might not actually materialize or that a company might even default on its obligations entirely.
Moving right along to Section 2, Market Structure and Regulators. Okay, so here is a crucial takeaway. The primary market creates the financial assets, while the secondary market makes them marketable and actually allows you to exit your investment when you want to. When a company first raises money, that happens in the primary market. But once those securities are out there in the wild, the secondary market, which is what we usually just call the stock exchange, allows investors to trade them with each other, transferring the risk from the seller to the buyer. Now, to keep things in check, oversight is strictly divided. CBSA is there to protect you in the capital markets, while the RBI handles the money markets and government debt. This dual-pillar system is absolutely essential. It ensures that the basic securities of the market are governed by strict rules, guaranteeing fair play whether you're buying long-term corporate stocks or just dealing with short-term bank deposits. All right, let's jump into Section 3, Decoding Equity Securities. There's a stark and honestly a very crucial difference when it comes to an IPO. A fresh issue actually brings brand new money directly into the company, whereas an offer for sale is basically just cashing out the early investors. This is something you absolutely need to check before you invest. Are you actually funding a company's future growth through a fresh issue, or are you just buying out some founder's shares in an offer for sale where the company itself doesn't see a single rupee of that transaction? It makes a huge difference. Here's a really common trap to watch out for. Let's say a company declares a 40% dividend on a 10 rupee face value. That is exactly 4 rupees. But if the stock is trading at 200 rupees, your actual dividend yield is only 2%. See, dividends are always declared as a percentage of the original face value, not the current market price. So whenever you're evaluating the income from a stock, you absolutely must calculate your actual yield based on the price you paid for it. Understanding these specific indicators helps you cut right through the market hype. They let you evaluate exactly how much the market values a company's real, tangible earnings and assets. The PE multiple, for instance, tells you exactly what you're paying for one single rupee of the company's profit. Meanwhile, the price-to-book value shows you how the market price stacks up against the company's actual accounting net worth. Using these basic tools is what keeps you grounded in financial reality. Switching gears a bit for Section 4. Debt and money markets. This comparison shows you just how incredibly flexible debt can be. These basic securities of the market aren't just simple IOUs. They can have embedded options that allow either the borrower or the lender to adapt if the broader economic environment shifts. Issuers use callable bonds to protect themselves if interest rates drop, while you, the investor, can use puttable bonds to essentially escape a low-paying investment if rates happen to go up. Now, if you remember one thing about debt markets, make it this golden rule: the inverse relationship. Because the coupon payout of a bond is fixed, the yield you actually get moves in the exact opposite direction of the bond's trading price. Think of it like a seesaw. If you buy a bond at a discount, meaning the price fell, your yield is going to be higher than the original coupon rate. They literally always move in opposite directions. When the central government needs a quick infusion of short-term cash, they issue treasury bills in the money market at these specific intervals: 91, 182, or 364 days. And the best part? They are completely free of credit risk. These are basically the ultimate safe haven basic securities. They don't pay a regular interest coupon like standard bonds do. Instead, they're issued at a discount, and then you receive the full face value when they mature. Finally, let's wrap things up with Section 5, Mutual Funds and ETFs. Mutual funds are brilliant because they pool your money with others to buy a professionally managed portfolio. You can target your exact risk appetite just by choosing one of these specific equity fund categories. You don't have to be some Wall Street expert to participate here. Look, if you want stability, you stick to large cap. If you want aggressive growth, you look at small cap. And if you're trying to save on taxes under Section 80C, well, the ELSS option has a built-in 3-year lock-in designed specifically for that purpose. This right here highlights the sheer power of asset allocation. Hybrid funds elegantly mix both worlds. They use the debt portion to act as a shock absorber, stabilizing your portfolio, while the equity portion is off chasing those higher returns. It's essentially an all-in-one solution that automatically balances your exposure to both the ownership and the lending sides of the securities market. Fixed maturity plans, or FMPs, are a fantastic tool if your investment timeline exactly matches the fund's term. Why? Because they practically eliminate the risk of price fluctuations at maturity. If you know for a fact you'll need your money in exactly 3 years, buying an FMP that holds debt securities maturing in exactly 3 years completely shields you from the day-to-day volatility of the secondary market. And then we have ETFs. ETFs bring the ultimate convenience to investing. They allow you to trade a heavily diversified portfolio, or even something like physical gold, as easily as buying a single stock on your DMAT account. They beautifully combine the broad diversification of a mutual fund with the real-time pricing and quick liquidity of the secondary equity market we talked about earlier. It's really the best of both worlds.
So, the securities market really doesn't have to be intimidating, does it? It's simply a massive toolkit just waiting for you to use it. We've stripped away the mystery today, looking at everything from the primary markets to the nuances of debt yields and mutual funds. You now have a clear view of the basic securities of the market that act as the plumbing for our economy. So now that you understand how the system actually works, what's your first move going to be?